Hey guys, and welcome back to Accounting 212. So today we're going to get started on Chapter 11, Standard Costs and Variances. Quite honestly, this is probably my favorite chapter of the course. We're really, looking into comparing what we thought we would spend and how much resources we thought we would use in our manufacturing or in our providing our services to our clients. And we're comparing those actual numbers to what we thought we should have spent or how much resources we should have used in providing those services or making our products. So we're gonna jump in here, and just as we go through the chapter, I want you guys to really there's 6 formulas, and they relate to our 3 manufacturing cost categories: direct material, direct labor, and manufacturing overhead, specifically variable manufacturing overhead. And that's the 3 categories, and then for each one of those categories, there's 2 formulas, 2 variance calculations, and that's really what I want you to be able to take out of this chapter. You understand what the standards costs are and why we look at standards versus actual. But for when we're talking about exam time, what I want you to be able to do is use the 6 formulas we'll describe. And I'll point out that even though there's 6, they all work in the same way. And just like with our under-applied or over-applied of predetermined of manufacturing overhead we saw back in Chapter 3, I have a shortcut formula and a quick and easy way to solve each one of these variances and understand what the numbers mean. So that's really what I want you to focus on, but we're going to go through. I also suggest, and I'm going to point this out as we go through, there's a couple spots where you'll want to have a scrap paper or your notes, and you want to write down some standard costs because we use them to kind of go through some guided examples through the chapter. So I'll point those out as we get to that. So let's get started. So learning objective number 1, we're going to explain how and why standard costs are developed. So what are standard costs? And standard cost is basically a budget for a single unit of product. So if we're thinking about being a manufacturing company, we would go through and we come up with a standard cost. If we're making jackets, how much resources, how much time, how much material should go into making one single jacket? And a company does that so that way they can extrapolate out, and when they're planning for their year or for their month or for their week, they can figure out how much resources, how much material, how much labor that we need to have so we can produce the amount of units that we are going to produce. If we're going to make 1,000 units and each one takes us an hour to make and it should cost us $20, we can extrapolate that and we can figure out how much it will cost us and how much time it will need to make 1,000 or 2,000. And that way we can kind of back into, if each one takes an hour and we're going to make 1,000, how many employees do we need, right? 1,000 hours in a week, an employee can work 40 hours, so you can work backwards to figure out how many employees we need to have making our jackets. So this standard cost allows managers, decision makers, to basically run their business. So without knowing these standards, you're kind of flying blind. It'd be like if you were in an airport or an airplane and all your instruments were turned off and it was nighttime. That's basically what would happen if you didn't have standards. And more sophisticated, bigger companies are going to have more sophisticated standards, more detail, constantly be refining them. Some smaller companies might just have a rough idea and they might not refine it for a year, 2 years, 3 years. But we'll see that these standards allow a business to go through and before they get started on the work, have an idea of what the resources they need, how many employees, how much material they need. And then after the fact, they can actually use it to judge some of the decision makers, right, on how good of a job they're doing based off of, are we off from our budgets? Are we missing our standards? And just keep in mind as we go through this, we're going to see just because we have a good variance or just because we have a bad variance doesn't necessarily mean that we're doing something terribly wrong. But by doing this, by having this information available, by doing these calculations, managers and decision makers of the business, right, they can figure out, they can look at, do we need to fine tune our process? Do we need to have more training? Do we need to update our standards? especially when we're talking about materials or labors. If we haven't updated those standards in a year or two, prices change, the cost of employees change. So it just allows us more information, and that's the key point of managerial accounting. That's why we're doing all this and we're learning about this. Whether you're an accountant and you're doing the work, or whether you're going to be a manager or owning a business and you're going to be interpreting this information, the purpose of managerial accounting is to provide information to our decision makers to make decisions about our business. So we develop a standard cost for each type of product. Service companies also use standard costs to figure out how much, if it's a accountant, how much is the standard for a tax return? How much is the standard for a specific client service? So we can figure out, are we spending too much money or too much time on that client or not enough time? So any type of business can use standards. It just will have to, obviously, a service company probably isn't going to be using the direct material standards. They'd be looking at the labor and the overhead variances. And it's going to become a benchmark for evaluating your actual costs. It's not the end all be all like I mentioned, but it gives us a place to start with. Here's what we should have. Here's what we actually had. Compare the two. Make decisions. Evaluate employees. Evaluate the standards. Go forward so you can make better decisions for the next year or the next month of operations. So we have three types of standards. So we have the ideal standard, and that's based off of on perfect or ideal conditions. We have perfection standards. These do not allow for any poor quality raw materials, waste, machine breakdown, or other inefficiencies. So if you're going towards like a lean production where you're just in time, everything works perfectly, you're spending a lot of time up front to make sure your process is perfect, you'll probably be using those. What most companies will look at with their standards is the practical or their attainable standards, right? Just like in life, we don't want to make goals that we cannot achieve. We want to make goals that are attainable, not something that by taking one step we can achieve it, right? We want to have goals that make us reach to be better, to improve, but at the same time we want to make practical goals, right? If the standard is that it takes 1 hour to make one jacket and we have an employee working 8 hours, we don't want to give them a standard of making 16 jackets. That's just not reasonable. It's not attainable. They have to be doing double the work in half the time, basically. But maybe if we push them just a little bit, right, just to get a little bit of an improvement, take a little bit, shave a little bit of time off of each jacket, maybe we can make 9 in a day, right? Shave 5 minutes or 7 minutes, whatever that math comes out to, off each jacket, work a little bit faster. Maybe 2 people can work together. If someone's really good at the sewing part, someone's good at the stitching part, the stuffing, if it's like a winter coat where it has insulation. Maybe we can work and get a better product by changing the way we think of our standards. So that's what we're talking about really when we go through this chapter. We have the ideal and the perfect standards up here, but we're looking at practical standards based on currently attainable conditions. And one of the things in business, just like in life, is when you're making predictions, when you're making budgets, when you're coming up with standards, you have to allow for normal waste and inefficiency. Especially in manufacturing. I don't know if anyone's ever done any projects where they're trying to make something, any carpentry or stuff around the house. You know, one of the things you quickly learn is when you're buying materials, you have to buy extra. If you need 100 square feet of tiles, buy 120 square feet of tiles because you're going to make mistakes. There's going to be one of the tiles might be broken when you get it back to the house. You might cut it wrong if you're trying to cut it. So in reality, for business, just like in your personal life, just like in, you have to budget, you have to set the standard to allow for a little bit of waste, a little bit of inefficiency. Especially if you think about a person working for you, the people doing the manufacturing or at the service, providing the service for the client, they need to be trained, they need to learn, they need to make mistakes to get better. That way, over time, they become more and more efficient. So when you're making those practical standards, you have to build in a little bit of buffer, a little bit of fluff, so that that is taken into consideration. And that's one of the things we're going to look at when we start talking about these variances is the standard is for a standard employee. If you have an employee that's been with you for 20 years, their efficiencies might be are hopefully going to be a lot better than the efficiencies of a brand new employee. But when you combine the two together, they should be the standard, and that's where our standards come from. So the standards are brought, they're made up by the people who've been there for a while. They understand the business, the process, hopefully, as I'm sure we've all been in a situation where a boss or a higher up comes in and tries to make a name for themselves, and they do something without really understanding the business, and they just snap their fingers. That was a snap of the fingers if you couldn't hear that on the mic. Snap their fingers and they suddenly want us to double the production. Well, you don't know our business, you don't know the way we work. That might just not be possible. So hopefully the standards are set by someone that understands the business, understands the market. One of the frustrating things from a personal experience was I was working for a large national accounting firm, and when you have people in other parts of the area that don't understand your own marketplace, making some of your budgets and some of your goals, and they want 10% growth when, in your area that might not be very realistic or very possible. Maybe a 5% growth would be better or more realistic. Because what you'll find if you've been working and you've been working with budgets and standards, one of the dangers of making budgets and standards is if they're unrealistic, right? If they're not practical, you might as well just throw them out the window, because your employees aren't going to buy in. They're not going to want to try. They're not going to want to try to achieve them because they know they're being set up to fail. So why put in all the effort when they know that they can't get the growth and they can't get the desired outcome that their bosses want? It actually creates, negative buy-in. It doesn't force, but it makes the employees not want to try as hard as they would have if they could have bought into a goal or a standard that they believe in, they know they can achieve. If you're set up for failure and it's going to lead to failure, it's going to kind of disenfranchise the employee. So now that I'm off on that tangent, we'll get back into the PowerPoint. So that's our standards. So really what we're looking at is the practical standards, based off of the current conditions. So information used to develop and update standards. So we have past materials and labor usage, current cost of inputs, estimated future changes, time and quantity that should be needed to produce each unit. So we'll talk about each one of those just a little bit. So really when you're coming up with a budget or a standard, best thing to do is look at what's been happening in the most recent past. How much materials, how much labor have we been using? And compare that to what you've been for outputs. So if we spent, $1 million last year to produce 10,000 units, and it was similar to the year before that, that's probably going to continue going forward. If it required 4,000 labor hours last year and 4,100 the year before that, those are good places to start. So the next year is probably going to be in that ballpark. So we start with what has been some past material and labor usage. We then look at the current cost of inputs, right? So the current costs of our material, of our labor. And that's an important thing we want to look at and want to remember as we go through this chapter. We're looking at the inputs into our manufacturing, the inputs of providing our services. We're not looking at the output. We're not looking at how many units we produced. We're looking at how much material went into the unit, how much labor hour went into the unit, how much overhead hours went into the units. So just keep that in mind. We're looking at inputs for this chapter, not outputs. So when we're making the standards for 2018, we want to look at the costs that we're seeing in 2018, right? Did our labor force, did we give them a raise? Let's update the standards. Otherwise, if we're using last year's labor prices on this year's standards, you're going to have some funky outcomes, because right from the start, employee number 3 is already costing us $1 more per hour, or $2 or 50 cents more per hour. So the standards need to be adjusted to reflect that. Same thing with materials. If you're in an industry that has fluctuations in their raw material prices, sometimes your standards, there's really nothing you can do about it. If it requires 5 pounds of raw material, think about the food industry. If you're making something if you're making hamburgers, and the price of hamburger went up, suddenly the quarter pounder you're making cost us a little bit more money, because simply our raw materials, not because we did anything on the company side, but just the cost of our material has gone up. So we want to be monitoring our costs to make sure our standards are accurate. We also want to try to have, some estimated forethought. Do we anticipate any significant changes on the horizon? So we just want to take that into consideration. Obviously, we can't see into the future. Otherwise, we wouldn't be in business. We would just be buying lottery tickets every other week. But you want to try to think about, based off of past trends, what we think future trends are going to be. What's maybe changes in your industry, changes in your profession, changes in prices, etc. And then the time and quantity that should be needed to produce each unit. And what companies will do is actually do a thing called a time study, where they actually have either the higher ups or an outside consultant come in, and they'll observe, maybe for a week, maybe for 2 weeks, the people, actually the direct labor actually making the products, and they can actually see what's going into, how much time does it take a standard employee to make one of your products, or how much time it takes from a car to go from a pile of materials to the end product. So they actually figure that out through time studies and through manufacturing studies, and they come up with, yes, each one of these cars is going to take 2 days to make, or each one of our jackets actually takes 55 minutes, not 1 hour to make. So we do these time studies, and they can be a little pricey and it's time consuming. So we try to do them not frequently, but maybe every other year, maybe every third year, just to make sure that our time standards continue to meet and are realistic. If you're thinking about a jacket and all of a sudden we're adding a lot more detail, a lot more stitching, a lot more design, all that stuff might add some time to that standard cost. So we want to make sure we're giving realistic standards for people to make. Because the important thing about standards, while it's a benchmark, we don't want to make unrealistic standards. Like I was saying, as we go through, just because we have a favorable or unfavorable variance doesn't mean that it's a good thing or a bad thing every time. It's just a spot where managers and the decision makers of the business should take some time and look at, why are we underperforming or why are we overperforming? Because just because we're overperforming doesn't always mean a good thing. If it comes to we're getting all of our work done 20% faster, right? And think about, if you guys are doing your homework 20% faster, maybe, and it's absolute a possibility that your professor, me, is doing a really good job of explaining it, but that's not always the case. Maybe it's that you're just understanding the chapter better, you understand the materials better, right? So those are two kind of favorable outcomes that are good, but there's also, you took 20% less time because you missed 3 problems, or you didn't understand the material and you missed a step. So, just because you spend less time or spend less material or it cost you less money doesn't always mean it's a good thing. It's just a place where you want to investigate. You want to look back and say, why were we good here or why were we bad there? And then make decisions. It kind of, if we think about, if you've ever done, use software where it highlights errors, if you've done your own taxes, some of the softwares, after you go through and you update your information, they'll flag some certain things that just say, hey, take a look at this again. Are you sure this is right? Or you might have missed something here, based off of their software. So that's what we're doing with these standards. We're saying, here's what it should be. You were way over or way under what it should have been. Let's just take a look, see why. Did we use too much material? Did we have inferior material? Did we rush through all of our jobs so our products look crappy? Did we not put enough food on the plate if we're at a restaurant, right? So you just investigate what's going on, because you want to, those standards, if you've put a lot of time and effort into it, should be kind of your gold standard of what we should have. So if you have significant variances one way or the other, right, just because it's a significant negative variance doesn't necessarily mean it's a bad thing. Maybe you had training involved. Maybe you had someone else that was called in sick, so someone else was forced to do the job. So it just allows managers to see a place where they should look into something more. So we compute our standard costs, and again, for this chapter, we're looking at inputs, not outputs. So we prepare standards for our materials, our labor, our manufacturing overhead, both variable and fixed. And I'm telling you right from the start here, right from the jump, what I want you guys to really know how to do backwards, forwards, and truly understand are our first three items: direct materials, direct labor, and variable manufacturing overhead. We're going to touch upon fixed. You'll see one or two questions in your homework related to the fixed, but on your exam, where I'm going to heavily test you, materials, labor, variable manufacturing overhead. So we're going to spend more time on that. The problems that you see in the homework are going to be more skewed towards that. The additional assignment I'll give you is going to be more skewed towards that. So yeah, we'll see that and make sure you understand that. So we have our standard cost of direct materials. That's what we're going to start off with first here. So our standard cost, again, this is our gold standard that we come up with. So here's how much material we should use and here's how much it should cost. So we look at one product, how much raw material, how much direct material should be used in making one item, and how much should that material cost us. So we have the standard cost of direct material. And again, for this chapter, we're looking at inputs. So we're focused on how much material goes into our product, how much that material cost us. Not the final outcome, it's what was going into it, what was used in our manufacturing. So our example here, we have Tuscan tortilla requires 5 pounds of flour at $1.50 per pound. All right, so here's what we're talking about as we go through some of these examples. This is the first thing you want to write down because we're going to follow Tuscan tortilla throughout the chapter. So our standard quantity is 5 pounds and our standard price is $1.50 per pound. All right, so we're talking about cases. That's our output is per case, but what we're looking at for our direct material variances is our inputs. So it's $5 or 5 pounds of material is our standard quantity, and our standard price is $1.50 per pound. So that's the two numbers you want to write down. And I would just suggest on your scrap paper, just write down direct materials. On the left side, direct materials, direct labor, manufacturing overhead, and then have two columns, quantity and then price. So for materials, we're going to have for our quantity is 5 pounds. For our price, it's going to be $1.50 per pound. Next line, we're going to have our direct labor. And again, our standard quantity. It requires each one of our case takes 0.05 direct labor hours. So that's going to be our quantity. And we're paying out $22 per hour. So we can see, again, we're looking at inputs, but each one of our cases takes 0.05 hours and $22 per hour. So each case costs us $1.10. Right, because 0.05 isn't going to be, so our employee can make a lot of cases per hour, but at $22 per hour. So each case of direct labor costs us $1.10. So that would be our second line. Our quantity is 0.05, and our cost is $22. So next we have our standard cost of manufacturing overhead, and we get a little wordy here on this slide. But we basically have our total estimated variable manufacturing overhead divided by our total estimated amount of our allocation base. So what does this sound like? Predetermined overhead rate. But for here, we're going to break it down between variable and fixed. So the first we do is come up with our variable manufacturing overhead rate. And then we based our standard variable manufacturing overhead per unit based off of the standard quantity of our allocation base times our variable manufacturing overhead rate. So basically we're coming up with our applied manufacturing overhead. We do the same thing for our fixed. We come up with our fixed manufacturing overhead rate, and then to figure out what the standard should be, we take our standard quantity of our allocation base times that fixed manufacturing overhead rate, and we come up with our standard manufacturing overhead per hour or per unit. So we have for Tuscan, we allocate manufacturing overhead using machine hours. Each case requires 0.1 machine hour. Tuscan plans to produce 400,000 cases using 440,000 machine hours. Tuscan expects our variable manufacturing overhead to be $1 million and our fixed to be 360,000. So for step one, we calculate our variable manufacturing overhead rate. So $1 million of variable manufacturing overhead divided by 40,000 estimated machine hours. gives us that our variable rate is $25 per hour. And then we figure out how much would be applied to each case. So it's 0.1 hours. So if we're talking about our manufacturing overhead, it's 0.10. That's our quantity, and our rate is 25. So if we're filling out our column still, quantity 0.1, price 25. So per case, it's $2.50. So 360,000 fixed manufacturing overhead divided by 40,000 hours gives us a rate of $9 for our fixed. So for our last column, our last row, excuse me, we're going to have fixed manufacturing overhead at 10 cents, or at 10 hours, 10 machine hour, 0.10 machine hours. That's our standard quantity. And then at a rate of $9. So if you filled it all out, what you should have when you're done is 2 columns, standard quantity, standard price. And then on the left-hand side, you'll have direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead. So our direct material standard quantity, 5 pounds at $1.50 a pound. Direct labor, 0.05 hours at $22 per hour. Manufacturing overhead variable, 0.1 hour at $25 per hour. Fixed manufacturing overhead, 0.1 hour at $9 per hour. So that should be what your table looks like. And now we can go and jump into our variances. All right. So take a minute, double check that. If you need to go back to the slides and write down those numbers, write them down. But we'll go forward from there. So that's all of our standards, and that's our standard inputs. Remember, whole concept of this chapter 11, we're talking about inputs. So our standard cost for 1 unit. So again, here is also, if you don't have the table written down, here's what you want to be looking at. So we have direct material, direct labor, variable overhead, fixed overhead, standard quantity, standard price. That's our basically A1 through A7 over to F1 through F7. That's the information you want to write down. And then we have our standard cost per case. So that's how much 1 case should cost us. All right, but we're going to break it down as we go through into each individual line item. Material variances, labor variance, overhead, fixed, and overhead variable variances. So really what you want to have on your paper, A1 down to A7, and then F1 down to F7. That basically that square. The G and the H, while it's important to know, won't play as big a factor into the rest of our chapter as the other columns we just talked about. All right, so again, I'll pause here for a minute just so you can jump in, write that down. If you need to pause the video, go for it, but I'll give you about 10 seconds here before I continue going on here. So you don't necessarily need to pause it, so I'll give you a break. Go ahead. Okay, so you should have enough time. If you don't have enough time, pause the video, keep writing down. So next we're going to jump into computing and evaluating direct material variances. So this is where we start having some fun. I love formulas. I love calculating variances. And the one thing you'll see, even though there's a bunch of formulas we're going to learn, they're all the same basic setups. And if you can identify the variables and what goes into that, and keeping in mind that we're looking at inputs, not outputs. So we're not looking at necessarily the number of units we made, the number of products we produced. We're looking at what was the stuff that went into making that material or that product. That's what we're looking at here, inputs, not outputs. So once you start going through these and seeing the way things are written and the way questions are set up, you'll be well on your way to understanding and fully grasping this concept. And again, why I like this so much is this is really where we start getting into some of our analytical skills and developing what we should be looking for in business. Here's how much things should be costing us, because we can make money if our cost of the items and our services and our products are costing us this. If they're not, we're losing money potentially. We might have negative cash flow. We might have negative profits, and it's going to severely hurt our business. So you want to understand what's going on. So our direct material variances, it can split the flexible budget variance for direct material into two different variances. So our total flexible budget variance, or your spending variance, which is your total between your standard and your actual, can be broken down into our direct material price variance and our direct material quantity variance. And I like to abbreviate our direct material price variance, I drop the direct, and just go with MPV, material price variance. And then right-hand side, we have our material quantity variance. All right. And this idea of a flexible budget, basically what we're doing here is saying, right, here's our standard for one, and then we just flux our budget to say if one should cost us $7.50 and we made $1 million, how much is that flexible budget? How much is that standard based off of our actual output? And then on the left-hand side, our actual cost is just legit how much we used at whatever price we paid. So that's the two sides of this setup. When you see flexible budget, all it means is here's your standard. Here's how much it should have cost us to make however many units we made. And then on the left-hand side, actual is just how much it actually did cost us to make those products. So that's what we're talking about when we see flexible. And then our total is our total flexible budget variance. So that's just the difference between how much it should have cost us and how much it did cost us. And then we break that down with, was it because we spent too much money on our individual unit, our individual materials, or did we spend not enough money? And then did we use too much or did we use not enough? So that's where we break this down. And so here, it's a big ugly slide and I don't really like it. But if you look at our purple columns there, our purple blocks, that gives us the formulas we want to use. So we have our direct material price variance, or MPV. I dropped the direct material, I dropped the direct out of there, so I just go MPV. So we have MPV equals, and this is what you want to write down. So again, you have your standards at the top of your scrap paper, at the top of your notes. So next, set up a column for your direct material variances. Write down MPV equals, and you can see at the bottom left what all of our AQ, AP means. So MPV, what you should write down is MPV equals actual quantity, AQ, and then in parentheses, AP, actual price minus standard price. All right, and then for direct material quantity variance, or as I abbreviate it, MQV, it's our standard price, and then in parentheses, actual quantities minus our standard quantity, SQ. Again, I dropped the A. This publisher, I really, really like the software. I really, really like the book, but sometimes they try to they add too many things to some of their abbreviations. So standard quantity, not SQA. You don't need the allowed or for actual output. So we have MPV equals actual quantity, parentheses, actual price minus standard price. MQV, standard price, parentheses, actual quantity minus standard quantity. All right, so that's our two formulas for direct materials. And we're going to be looking at our inputs, so our actual quantities used, or our standard quantities we should have used, the actual prices we paid, and the standard price we should have paid. All right, so we're breaking down between what we paid versus what we should have paid, how much we used versus how much we should have used. So that's what we're looking for. That's how we can calculate our variance. All right, and with all of these formulas, all the first 6 formulas we look at, materials, labor, and overhead, variable, if they're all going to have a similar setup, a similar field, we have one variable outside of the parentheses and then an actual minus a standard inside the parentheses. All right, so for every one of these, if our answer is positive, assuming you set it up, number variable outside the parentheses, inside actual minus standard, set it up every time like that. If we do that, if our answer is positive, we have an unfavorable outcome. All right. If the answer is negative, we have a favorable outcome. And if you just look at the very first variance calculation, price variance, MPV, if you look at it, what's going to determine that is what's inside the parentheses. So if our actual price that we paid was greater than our standard price, we're going to end up with a positive number in the parentheses. Therefore, we spent more money than what the standard says we should have. So that's unfavorable. We spent more than we should have, right? If we're making chocolate candy bars and we had to pay more money for the cacao, which is one of the main ingredients in chocolate, if we spent more on that per pound than we should have, that's bad. That's going to lead to unfavorable situation. We spent more than we should have. At the same time, if our actual price minus our standard price is negative, meaning what we paid was less than what the standard says we should have paid, that's favorable, right? So that number is negative, favorable. So for every one of our first 6 formulas we're going to look at, material variances, labor variances, and variable overhead variances, set it up this way: variable and then parentheses actual minus standard. Therefore, if your answer ends up being a positive answer, you have an unfavorable outcome, negative, favorable outcome. Because for all of these problems, as we go through them, your answer isn't just the number in your calculation, it's the favorable, unfavorable. That's where really the crux of the problems are. Are we favorable outcomes or are we unfavorable outcomes? All right? But that's your shortcut way. If you set it up this way, basically the setup in the purple boxes here on the screen, if your answer is unfavorable, or if your answer is positive, it always means it's unfavorable. If it's negative, it always means it's favorable. All right? So we have our 2 different variances, and again, if we combine them together, that comes up to our total material variance. All right, so if we had our price variance was unfavorable by 1,000, but our quantity variance was favorable by 500, we would put them together, and basically whichever side wins out is if it's favorable or unfavorable in total. So 1,000 unfavorable, 500 favorable. When we combine them, we're left with a 500 unfavorable because the unfavorable portion of that was larger than the favorable portion. Okay, so here's our explanation. So how much for direct material price variance? How much of the variance is due to paying a higher or lower price than expected? For our direct material quantity variance, how much of the total variance is due to using a larger or a smaller quantity of direct material than expected? So we have here, and this is where we start going to do some calculations of our own. So we have our standards. We should have written all those down. And now here's the actual information. So we actually produced 31,000 cases. We purchased 160,000 pounds at $1.40 a pound. And our direct material we used everything we bought. So we have nothing left over for materials. So if you get into the real world, what we're going to focus on is we're always going to assume what we bought was the same as what we used. If you had bought 160,000 pounds and you only used 140,000 pounds, our formulas have a little bit of a tweak to it. But for this, all I want you guys to focus on, I'm not going to throw more wrinkles into this chapter. Just know that there are slight variances if there are differences between what you purchased and what you used. We just switch around our actual quantities in our formulas. But for our chapter here, we're going to focus on if we purchased it, we used it. So we don't have to worry about using different actual quantities. So we have our calculation here. So we go through and they use the setup here. Again, I don't use this setup. I like just going straight to the formulas. So we can go here. They have it here. Yeah, here we go. So we have... I guess they don't have, actually in this chapter, they don't have the breakdown of how I would have liked to see it. So that's sad. So basically what we would do here, I'm actually just going to skip. So I'm going to stop this PowerPoint here for a second. I want to pull up Excel because I want to show you guys exactly how you would have done that, because I like to use the formulas. So I want to show you how you would use the formulas. So we would have had here's our direct material, here's our direct labor, here's our variable manufacturing overhead, here's our fixed manufacturing overhead, here's our quantity, here's our price. So for quantity, 5 pounds, $1.50. Direct labor, 0.05, 22. Variable and fixed, 0.1, 0.1, 25, and 9. So these would all be dollars. So throw some dollars there. These are all hours, so we're just going to make those numbers. There we go. So that's our standards. Here's our standards. And then here's some of our actual information. All right, so we have actual, and we're talking about materials, direct materials. So if we go back to the PowerPoint, so we had cases, number of cases produced, 31,000. Direct material, so that's cases produced. So we have direct material purchased. So we had 160,000 pounds purchased. And we have direct material at a price of $1.40 per pound. Throw that. I'm going to do that in parentheses. All right, so that's our standards for direct material. So we have our material price variance, and again, that's going to equal our actual quantity, and then actual price, and then standard price. All right, so I'm just going to write a little formula. So it's going to be our actual quantity when we fill that in, and then in parentheses, actual price minus standard price. It's showing up as a reference because right now we don't have anything in there. So we have our actual price that we bought our pounds was 1.4. We have our standard price that we should have had was 1.5, and I'm just going to throw some formulas. 1.4, 1.5, and then we had our actual quantity was 160,000 pounds. That was less exciting than I thought it would be. So we have that. That should be multiplied. There we go. So negative 16,000. So if we go here back to our slides, we can see right there in purple that our direct material price variance is 16,000 favorable. And if we go here to our formula, our MPV ended up being 16,000 favorable because it's negative. Remember what I said? If your answer is negative, it's favorable. If it's positive, it's unfavorable. So we have a 16,000 outcome negative, so unfavorable. All right, so next we'll do our MQV. Again, we're going to use our formula here. So it is our standard price, actual quantity, standard quantity. All right, so we'll write our formula here. So it's our standard price times our actual quantity minus our standard quantity. So our standard price, again, we come up here, standard price, $1.50. Actual quantity, again, we used 160,000 pounds. All right. Here's where the one kind of tricky part is for our standard quantity. We want to know how much we should have used in making our 31 cases, right? So it tells us in our problem we produced 31,000 cases. Our standard says each case should use 5 pounds. So to get our standard quantity, we take our number of cases produced times our 5 pounds per case. So that tells us that we should have used, to make 31,000 cases, we should have used 155,000 pounds. So our MQV answer is 7,500. And remember, if it's positive, that means it's unfavorable. All right? So if we see here, we're going to jump back into the slides. We just calculated 16,000 favorable, 7,500 unfavorable. All right? Apologize for the little confusion there. I thought that that's how it had it in the slides. I could have sworn maybe I accidentally deleted it, but that's the way I would suggest solving it, using your formulas. That way it's you cut through kind of some of the extra steps here. The way the book has it and the way most publishers show it is using this actual cost, actual quantity times standard quantity, standard cost, allowed. You have to do a couple extra steps. But you can see there our direct material price variance, 16,000 favorable, which is what we solved for. Our quantity variance, 7,500 unfavorable. And then our total is when we just push the two together. So if we come back to our Excel file, our total is we just take this plus this. And again, same concept. If this number is negative, it's favorable. All right, that's what we got here. So our total direct material variance, 8,500 favorable. So you can do it this way, actual quantity times actual price, actual quantity times standard price, standard quantity times standard price, or you can go and use your formulas. My suggestion, the way I solve these problems, the way you just get used to doing them, solve using the formulas like I did in the Excel file. So you have our total variance there, 8,500 favorable, and that's basically because when we add our two variances together, the ending number is still 8,500 and it's still negative, so it still retains that same. If it's negative, it's favorable. If it's positive, it's unfavorable. So there are times, and I did mention this quickly, that there are times where the quantity used differs from the quantity purchased. So if that's the case, for our direct material price variance, we're going to be calculating our actual quantity is our actual quantity purchased. For our direct material quantity variance, that's going to be based off of the quantity actually used. So if you see a problem that has, here's the amount we purchased, and here's the amount we used. So if you see those two numbers, an amount purchased and an amount used, and they're different, we have to use our actual quantity purchased for price variance. And the way I remember that is actual quantity purchased, AQP, we use it in the price variance. There's a P in price variance, there's a P in purchase. So that's how I remember those. And then the other one, actual quantity used, and the way the book has it here makes it really helpful to you guys to remember that. AQP, actual quantity purchased, so you just add the extra P there, and then for quantity variance, it's AQU, so actual quantity used. If there is no difference, right, if there is no difference at all, or if the problem that you're given is silent on the quantity used versus quantity purchased, we just use the same amount for our actual quantity. This is only the case if the problem specifically tells you we purchased X, but we only used Y. Okay? Otherwise, it's the same actual quantity. So I'm not going to go through that example. For the homework, I don't believe there's a focus on that in the homework. I'm just double checking as I'm talking to you guys. Really what you just want to focus on, what you want to know, is that there is that difference. All right? I can't, let's see, 20... Yeah, I don't see any of those variances. If there are, though, just know for your material price variance and your material quantity variance, MPV, we use purchased quantity. MQV, we used actual quantity used. So just know that. So if you see that problem in a quiz question or in a homework question or in one of the examples that I give you guys for the supplemental problems to help you out, just refer back to your slides there. Okay, so next we're going to compute and evaluate our direct labor variances. So our direct labor variance, again, next set of formulas we should want to write down. So how much of the total labor variance is due to paying a higher or lower hourly rate, which is our labor rate variance. So again, it's our same setup. So LRV equals our actual hours in parentheses, actual rate minus standard rate. Labor efficiency variance, how much of the total labor variance is due to using a greater or lesser amount of time than anticipated. So our LEV is our standard rate, parentheses, actual hours minus standard hours. And you can see again, we have a variable outside of the brackets, and then inside we have an actual minus a standard. So if our answer is positive, unfavorable, negative, it's favorable. So we have here, here's where the examples use the formula, which is again, my 100% is how you should be doing these. It just makes your life that much easier, and you want to just keep doing the same way over and over and over again. So we have Tuscan actually used 1,500 hours of direct labor at $23.25 per hour. Its actual standard rate was $22 per hour. Its standard rate was $22 per hour. Okay, so again, we knew the standards already because you guys have your chart with everything written down. But we have our actual hours times our actual rate minus our standard rate. So we have 1,500 was our actual hours, actual rate, how much we actually paid our employees, $23.25, minus our standard rate, $22. So we have a positive number, therefore we have a unfavorable outcome, $1,875. Next, we have our direct labor efficiency variance. So Tuscan actually produced 3,100 cases. Its standard rate was $22 per hour. Its standard number of hours was 0.05 hours per direct labor case. So again, with your standard hours, we generally are given how many products we produce, so how many cases, and we know how much each one of them should have taken us. So generally, that's one of the tricks for all of these is that standard quantity or the standard hours is we take how much one should have taken us, how much quantity or how much time it should have taken us. Then we multiply it by the number we actually made. That's where that flexible budget we just talked about, if one takes us 0.05 hours, how much should 3,100 or 31,000 have taken us? So we just scale that up or scale that down. That's why for our standard quantity, we're given the quantities and for one item. That way, if one takes us an hour, or one takes us 5 pounds, or one, like here, takes 0.05 hours, we can then figure out how many 31,000, how many 40,000, how many 50,000. So we have that flexibility. All right, so we have our standard rate, 22, actual hours, 1,500, and then our standard hours would be the 31,000 cases we made at 0.05 per case. So if we do that, we get 0.05 times 31,000. That's going to equal 1,550. So we have our standard hours were 1,550. Our actual hours were 1,500. So when we do that math, we're going to end up with a negative value. Negative 50 times 22. That's where we come up with our 1,100 variance. And again, our answer is negative, so it is favorable. All right. So then we calculate our total direct labor variance. We take our 1,875 unfavorable rate variance. We add that with our 1,100 favorable efficiency variance. When we put them together, we end up with a still positive answer of 775, a 1,875, basically plus a negative 1,100. Still ends up with a positive number, so our total direct labor variance ends up still being an unfavorable outcome. All right, so we can see, while we have 6 formulas that we're going to be really focusing on, and then a 7th and 8th for our fixed manufacturing overhead, but so far it's the same basic setup for these formulas, and the outcomes we determine the same way. If it's favorable, if it's unfavorable, it's just simply based off of is it positive or is it negative. Okay, so here is another really, really, really good slide. One, it tells us all of our formulas. So I would just, if you're taking notes at home, or if you just print out some slides with you, here's some great one. Is a great one for you to add to that. It also tells us when we have these variances, should we be talking to the purchasing supervisor, the production supervisor and HR, the production supervisor? So it tells us, depending on which variance we've just calculated, really who is the primary responsible party for that, right? So if we have a materials price variance, so we paid too much or we paid a lot less than the standards, we're going to go talk to the purchasing supervisor. Hey, why did we spend on average $5 more per pound? Or why did we spend $3 less per pound? So why did we have this variance? So it might be a situation where they are just, we bought materials went up, it was out of our control. One of the dangers, again, when I was saying that variances aren't all treated equally, just remember that just because you have a favorable material price variance, we spent less than we should have. Anyone here ever bought something from Amazon and you spend a lot less than you thought you would have, and then you get it and it's a piece of crap? I've done it. I bought something from an overseas vendor, and then you get it and it's the wrong size, or if it's clothing, you wash it once and it falls apart. If it's like electronics, you use it for a week and it falls apart. I think we've all been there. So that's what I was telling you at the very jump off of this chapter, is that favorable doesn't always mean good. Unfavorable doesn't always mean bad. It's just, here's something you should investigate. We should get to the bottom of it. It might ultimately end up being good or bad, or it might end up just being something out of our hands. But it allows our decision makers to go in and take a look at, hey, why did we have a variance? What went on there? So some of the advantages and the disadvantages of using standard costs. So some of the advantages, it gives us cost benchmarks. It's very useful for budgeting, for motivation, and it simplifies bookkeeping. It allows us to do, with our standards, here's how much things should cost. And then as we make them, we can just use our standards. And then just like with our predetermined overhead rates, we can just basically go back at the end of the year and kind of reconcile. Here's what the standard said we should have. We were off, so let's just fix it right at the very end. So that way we don't have to be going through and calculating our cost per unit daily, weekly, or whatever. We can use our standards to just simplify our bookkeeping. It allows us to have benchmarks. It allows us to make these decisions and get this feedback. And for budgeting purposes, if we know we're going to make 31,000 cases, it allows us to go through and budget out how much time, how much material we need. It's also a way of motivating employees, right? Here's your budget. We got to make 31,000 cases this week or this month. So let's try to get to that goal. If we didn't, if we're within our time frame, maybe the people get bonuses. Maybe we got a day off or something like that. But it gives our employees something to shoot for, something to aim for as they go through and they're making their products, their manufacturing. Let's hit our numbers. Let's get to our budget. They get pride. End of the year evaluations could be based off of that. Year-end bonuses could be based off of that. So it gives them motivation. Some of the disadvantages of using standard costs, again, is timely to come up with these standards. And sometimes, and by sometimes, I mean a lot of the times, it's outdated and inaccurate standards. So we came up with a standard back in 2009, and hey, that was only 9 years ago. Why do we need to change it? So they can be outdated, they can be inaccurate. Again, the lack of timeliness. So it could be, again, that they came back from 3, 4, 5 years ago. Things happen. We can't always go through. It takes some time to develop them. The problem is if you're not monitoring and updating them, your costs, your time are going to get out of control and skewed. So it's not going to be as useful information. Really, one of the problems with a lot of these analytical tools, these decision-making tools, is it doesn't directly impact the bottom line in the short term. And so in businesses, sometimes they're overlooked. Yes, this is a great idea, but it costs us money. We have to have someone spending time to come up with these standards, to develop these tools, to calculate these variances, to make these kind of upfront costs to help long-term over time. But businesses sometimes shy away from spending money where they don't see immediate ROI, return on investment. It focuses on operational performance measures and visual management. There's lean thinking involved. It increases in automation and decrease in direct labor. Unintended behavioral consequences. So again, while it motivates employees, again, they might be rushing through to meet those standards, to meet those products, which might have an unintended behavioral consequence where we're dismotivating our employees. We're forcing them to take shortcuts in their work. So there's a lot of different advantages of that, but everything in business, just like most things in life, there's two sides to the coin. So you just got to be careful. You don't want to just say, here's the standards, they're in black and white. If you're unfavorable, you're fired. If they're favorable, you got to raise, because it's a tool that should be used to allow managers and to allow decision makers to become better managers and better decision makers and improve their process. But it shouldn't be the absolute end all be all. It's a tool that we use to do better jobs. So next we're going to go through, and again, this is our 6 formulas, this is our last kind of batch, and that's our variable manufacturing overhead. And you'll see they're very close to our direct labor rates and our direct labor efficiency variances. So we have our variable overhead rate variance. So that's the difference between the actual variable manufacturing overhead cost incurred and the amount of variable manufacturing overhead expected. So we have our actual hours, parentheses, actual rate minus standard rate. So it's the exact same formula as our labor rate variance. All right. The only difference is our rates and our hours. Make sure you grab your overhead. Make sure you grab your overhead cost driver hours and your manufacturing overhead rates. A common setup for this type of question, especially on an exam or on your homework, one of the larger problems, is to give you all the information and have you calculate all the variances based off of one set of information. So just make sure you know, even though it's the same formula, the variables have different meanings for overhead versus labor, because it's the labor rates, so the labor manufacturing overhead rates versus the labor rates, and then the manufacturing overhead hours versus the labor hours, because sometimes there's different cost drivers there. Lastly, we have our variable overhead efficiency variance, and that's the difference between our actual amount of allocation base used, cost driver, and the standard allocation based allowed. So that's the same way that we've seen with all of these, the quantity and the efficiency variances so far, is we have to calculate the allowable standard hours. So we have our example here, and they have all of our information. So we have our actual hours that we used, 3,000 machine hours. Our actual rate, $28.40. So we got that again by taking our actual variable manufacturing overhead, 85,200, divided by our 3,000 machine hours. And then we have our standard rate, which was $25 per hour. So again, 28.40 minus 25 is a negative number. So when we do our math out, it's going to end up with an unfavorable number because it's negative 10,200. All right. Next, we have our efficiency variance. So we got our standard rate, 25, actual hours, 3,000, and then our standard hours, again, each case should take us 10.10 machine hours, and we made 31,000 cases. So 31,000 times 0.10 would have been 3,100 hours is how much the standard would have allowed us to use. We only used 3,000, so we have a difference of a positive 100 times $25 per hour. So for our labor variable overhead efficiency variance, 25 times 100 gives us a positive, 3,000 minus 3,100 is negative, times 25 gives us a negative $2,500 outcome, and when it's negative, it is favorable. So again, we can see that visually here. We have our variable manufacturing overhead rate variance, 10,200. We have our variable manufacturing efficiency variance, 2,500 favorable. Our difference, again, when we push our two variances together, we would have had a positive 10,200 minus or plus a negative 2,500 because that was favorable. When we push them together, we still end up with a positive number. So our total overhead, variable overhead variance, 7,700 unfavorable. So last, and this one is just be aware, really, and for your homework and for your quiz, you might see it. On the exam, it would just be aware that we also have these variances for fixed manufacturing overhead. So we have our fixed manufacturing overhead budget variance. That's the difference between the actual fixed manufacturing overhead cost incurred and the budgeted fixed manufacturing overhead cost. So you have our actual fixed minus budget. So for this one, again, I include them because I've included a couple of them in the problems for your homework. Of the 6 formulas, or the 8 formulas for the chapter, the 4 variables we've talked about, material, labor, variable overhead, and now fixed overhead, this is the one that I find to be the least useful, if you will, as these costs are fixed. So they are what they are. If we produce more units or less units, this is really kind of an extension, and in my opinion, an extension of looking at your predetermined overhead rate versus necessarily just looking at your cost variances. Because in theory, your fixed overhead, it is what it is. Whether or not we had more or less manufacturing, whether we spent more money or less money on our products or on our labor, it doesn't matter with the rent. It doesn't matter with, for the most part, utilities, depreciation, which are generally some of your bigger fixed overhead costs. Those don't really matter. Those aren't going to change. So I included in here because it's included in 2 of the homework problems, but they're included in 2 of the homework problems as more of, they're just an add-on to some of the other problems, the other parts that I really like. So less important, it's not going to be a focus on your exam, but just be aware of them. And because in my opinion, it's your fixed cost. So they're not going to, the only difference would be is if you budgeted them wrong. And that's more of like a human error than a manager error than necessarily a result of your production schedule, right? Because if you just miscalculated your rent in the beginning of the year or your rent changed, that didn't really because the people involved in the manufacturing messed up. That's because the people making the budgets didn't put the right number in. So it's not as important in my opinion, just because in theory a fixed cost isn't going to change whether you produce 1 unit or you produce 1,000 units. But just know we have our fixed overhead budget variance. It's our actual fixed manufacturing overhead minus our budgeted fixed manufacturing overhead. And then we have our fixed overhead volume variance, which is the difference between the budgeted fixed overhead and the standard fixed overhead cost allocated to production. So there's our 2 variances, and you can see they don't even have the 3 variable setup. So it is what it is. Be aware of them. But again, your focus this chapter is your material variances, your labor variance, and your variable overhead variances. Those are the 3 categories, the 6 formulas you want to know. So here we have Tuscan actually produced 3,100 cases with a standard hours allowed of 0.1, and then machine hours per case, and then the fixed manufacturing overhead is 9 per direct labor hour. So we have our standard hours is 3,100 times 0.1 times our $9 per hour. So we have our standard fixed would have been 27,900. And then our budgeted was 30,000 fixed manufacturing overhead cost. So we'd have 30,000 minus 27,900. All right, so that's just unfavorable 2,100. And again, the 30,000 came back from the beginning of the chapter year standards. We then have our fixed overhead volume variance we have on the right-hand side. We have our fixed overhead budget variance. We budgeted 31,025 compared to our standard. Our budgeted was 30. Our actual manufacturing overhead at the end of the day was 31,025. So we had an unfavorable 125 there. Our fixed overhead volume variance is 2,100 unfavorable. So when we put those together, we have a total overhead variance of 3,125. Again, just know how to do these for your homework. And it might show up on your quiz, but on your exam, I'm not going to focus on them because I don't think it's an important part of the purpose of this chapter. I think it's just thrown in there as kind of yes, there's that last piece of manufacturing overhead. It's not just variable. But again, your fixed costs, they're fixed. So this is probably just maybe your rent went up a little bit. No impact on the manufacturing. It just rent went up because maybe there was a price escalator or something happened where you had to pay a little bit more. So it's less impactful. You can make less really decisions on them. So if production volume is greater than anticipated, then fixed overhead has been over allocated and the fixed overhead volume is favorable. If production volume is less than anticipated, then fixed overhead has been under allocated and the fixed overhead volume variance is unfavorable. So it's really related to we had this amount of overhead total and fixed, and then we use that based off of this anticipated level of production. So if we didn't produce as much as we thought or we produced more than we thought, we're now just spreading out this fixed overhead over more units or less units. So that's really the crux of what's going on here. And it really kind of just looks back at, did we have more overhead than we need, or did we anticipate more than we had? So again, for this class, for this exam, what you want to know, material variance, labor variances, and our variable manufacturing overhead. So those 6 formulas that have the setup of a variable, then parentheses, actual minus a standard. Those are the 6 you want to focus on. Those are the 6 you want to know. Just refer back to your fixed overhead formulas when you go through. They're parts of 2 of the homework problems that you'll need that for. So that's the end. So that's the end of the chapter, and we're just about done with the semester. So just keep going, keep putting in the effort. And as Homer's telling us here, the end is near. The end of the semester is near. So I hope you enjoyed this. Take a look at what we have to do for the week for chapter 11. You get your normal homework and quiz, and I'll post a kind of some practice problems and a discussion board for this week, talking about examples of when a favorable or unfavorable variances can be good or can be bad. So we'll go through that. That's the end. Hope you enjoyed it. As always, if you have questions, shoot me an email, and we'll see you next week. Thanks. Bye.